Consumer mood just dropped to near record lows. Tech stocks finally blinked after their monster run, and Fed officials are out hinting at balance sheet growth again while still debating that December rate cut. They just don't want to let us have it. And then pair that with the ongoing tariff overhang and weak market breadth, and you've got this market that needs a new playbook and fast. So let's blast over and check out the headline that really set the direction for markets today. And that was from the University of Michigan's Survey of Consumers. The Consumer Sentiment Index for early November came in at 50.3. That's below the expected 54 we thought we'd see. Also note that that was down from October's 53.6. This is just above the 2022 inflation panic low, but among the weakest print we've seen in the survey's history. Some of the main drivers included the current personal finances being down about 17%, the year ahead business conditions down 11%. We're also seeing the ongoing government shutdown now the clear fear point in the responses. Inflation expectations for 1 year were up to 4.7%. That's not a huge increase from the previous 4.6% read we got, but the concern comes when you consider that that number's going up and not down. But we did get a little form of relief when we look at the longer term expectations because that came in at 3.6%, down from 3.9%. Now below the midpoint between last year and this year's April peak. Weakness is pretty broad by some of the factors like age, income, and politics, except for that top percentile that posted a notable 11% increase in sentiment, mainly due to the equity strength we've seen this year. And this one makes sense. Lower income households remain the most pessimistic. Go figure, as they're less likely to share the optimism from the market's performance this year, mainly because they're less likely to own assets like stocks, which have gone up this year. And if they did own assets like stocks, it's not like they own a whole bunch of shares of stock. So when stocks go up like they did this year, it doesn't really move the needle much for them. They're still struggling, prices are still high, and interest rates are still high. And then on top of that, we heard from the New York Fed. We got their latest survey for October, and that adds more detail into how households are feeling. And I'll tell you, that one gave a really mixed picture. So inflation expectations from their point of view actually ticked down a little bit. Median 1 year ahead expectations slipped to 0.2 percentage points to 3.2%, while the 3-year and 5-year expectations really stayed anchored at that 3%. Now, the disagreement between respondents, basically how split people are about where prices are headed next, that number widened across all horizons, pretty much meaning confidence in predicting inflation is fading away. So people are saying, we don't know what the heck's going on. And then when we look at more specific categories, we got categories like home price growth expectations staying locked in at 3%. This is for the 5th straight month. Gas and food expectations cooled slightly to 3.5% and 5.7%. But if we turn around and look at college costs and medical care, both of those jumped. So for college costs, we've seen that number really jumped up 8.2%, and then medical care costs being up 9.4%. That's the highest medical read since early 2023. Then rent inflation expectations rose again. That one's up 7.2%. Then the labor market expectations are showing stress within itself. Median expected earnings growth picked up slightly to 2.6%. That's still below the 12-month average. The perceived chance of unemployment will be higher a year from now. That rose to 42.5%, marking its 3rd straight monthly increase. Meanwhile, the odds of losing a job fell by about 14%, but confidence in finding a new job also dropped to 46.8%. And that weakness came mostly from that younger crowd and also from people who are college educated respondents. The expected quit rate also eased to 18.8%, really signaling workers are getting less confident about switching jobs for better pay. So we're seeing that they're deciding to stay put. And then when we zoom in on household finances, that cautioned its own tone. The expected income growth edged down to 2.8%, while spending growth nudged up to 4.8%. A slight rise that's been holding in a really narrow range all year. More households are saying credit access has improved both now and looking ahead. The easiest conditions reported since late 2024 last year. Still, the probability of missing a debt payment over the next 3 months increased slightly to 13.1%, and expectations for higher taxes fell to 3.2%. People also expect government debt growth to slow to 7.2% next year. Now on markets, only 38.9% of respondents think US stocks will be higher a year from now, a small but notable decline in optimism. I wonder where we're going. And then taken together, we see a story of consumers who are really feeling this kind of squeeze. They expect slower income gains and see higher prices for some of these key essentials, but still plan on spending modestly heading into this holiday season. And then check out this one. This one's another kind of sentiment in its own. It's more from a business sentiment point of view. Wendy's plans on closing 6,000 stores across the United States through the next year. One more corporate signal that operators are tightening themselves. Now, the price action we see in markets is that the best streak met its worst week. So once we look at how markets performed today, the S&P 500 is up 0.13% on the day. The Dow gained 1.6%. The Nasdaq fell 2.8%. Now, for the week, the S&P lost 1.7%. The Nasdaq for the week is down 3.82%. That's its worst week since April's Liberation Day, that tariff shock. The Magnificent 7 ETF booked its biggest drop since mid-April. Now, as far as crypto goes, Bitcoin gained 1.49% today. It's back above 100,000 after breaking below earlier this week. Now, since the April sell-off, the S&P booked 6 straight months through October. So 6 straight months of just up for the S&P 500, which is the longest run since 2021. The last 2 months saw $36.5 billion into tech and AI funds, which is another record within itself, and $19.6 billion to broad equities over the past week, the longest inflow streak since December 2024. There's always a new streak or new record to break. So this matters because we see positioning is really crowded. They're crowded into these AI winners and this is where it kind of gets a little scary. While people's crowding into some of these AI plays that have been winning, 62% of stocks sit in some form of downtrend showing weak market breadth. And for context, here's a little bit of breadth 101. So market breadth measures how many stocks are participating in the move. Strong breadth equals broad participation. So when there's strong breadth, a lot of stocks in the S&P 500 are all going in that upward direction. Now, when the stock market's moving up, like the S&P index is moving up, but there's weak breadth, what that's pretty much saying is that there's few mega caps pulling the index up while most of those names lag. So weak breadth makes rallies more fragile and pullbacks sharper because it's pretty much like one person's pulling up, or like a few percentage of them pulling up, and then the rest of them's like free falling down. Citi's read is that this wobble isn't just an AI return on investment anxiety, rather the larger driver is declining system liquidity. So the Treasury's rebuilding its TGA, that's the general account, and effectively pulling cash out of the system. Bank reserves are down about $500 billion since mid-July. Now, once we go back, let's bring our attention to Bitcoin real quick. So let's pull up Bitcoin. Let's just put it on this one chart, BTC, USD. Put this sucker on the hour chart. And what we see for Bitcoin is usually it's seen to be more sensitive to pure liquidity. Now, Bitcoin fell more than 20% from its high, which is considered bear territory for Bitcoin before today's bounce, of course, because it's not down 20% from its all-time high anymore. But we've been saying Bitcoin falling can be seen as this bad omen for stocks going forward, and this is really why. So historically, falling reserves hit Bitcoin first. Then it heads into equities, and this week stocks finally reacted in some way. Now, if the dollar stays firm and Bitcoin stalls, risk appetite is likely to stay capped for now. People like treating Bitcoin as a leading indicator for a few different reasons, including that it trades 24/7, it's high liquidity sensitive, and it has fewer fundamental cash flow anchors, so it's often the first asset to move when the dollar liquidity tightens. So if reserves keep slipping, maybe expect a continued chop if some of the high beta tech names and some of these AI beneficiaries continue to move in that downward direction. Now, we got sentiment, and that's tanking. Investors are nervous about valuations, breadth is thin, yet Q3 earnings are pretty strong. About 83% of the 424 S&P 500 reporters beat earnings, so that's pretty good as far as earnings go. Aggregate EPS, so that's earnings per share surprises, that's over 10.4%, about the best since Q2 of 2021, which was a pretty euphoric time. Now, skeptics circle back to leaders. When the concentrated winners crack, sentiment damage spreads, add in street heavyweights warning of potential 10% to 20% move downs in the market, so drawdowns. Like some of what these bank CEOs are kind of letting you know, like, hey, you could probably expect this. And then Michael Burry shorting key AI names like Palantir and Nvidia. Investors treat that kind of stuff, like these warnings from bank CEOs and Michael Burry shorts, as reasons to reduce risk and just take some of the chips off of the table while stocks are at all-time highs. And then we heard from Vice Chair Philip Jefferson. He came out today and spoke more about his policy stance. Cut last week because labor risks rose. Rates are still above neutral, but closer now. So we kind of already knew that. December cut is a close call, so they don't want to tell us much about what they plan on doing regarding rates come their December 10th meeting. They want to take it meeting by meeting, be data dependent. He wants to proceed slowly as we approach the neutral rate. Inflation's similar to a year ago. There's a lack of progress, and that's tariff related, but there are signs underlying inflation keeps drifting towards their 2% target. And then regarding AI adoption, it's exploding. Consumer and enterprise use is rising fast. Some firms are already rescoping headcount because of AI. Then once you look at productivity, research shows material gains like, for example, faster scientific progress. Now, in regard to the labor market, there is near-term job displacement risk for some occupations in relation to AI, but in the longer term, he sees new categories and higher output potential. So it might be tough regarding AI in the job market for a little bit, but he's saying what Philip Jefferson's saying is that it'll get better eventually. For prices, productivity could push prices down. Build out like data centers, energy, land, skilled labor, that can push certain prices up. So the net effect on inflation is ambiguous and uneven by sector. Then you add in policy. If AI lifts potential output, then the Fed may not need to react as hard to these tight labor reads as in past cycles, but it's premature to really try to bake that in yet. So they want to go meeting by meeting, take it slow, and be data dependent. So then New York Fed John Williams also spoke today. Today was a busy day, y'all. And he mentioned QT, quantitative tightening, and how that's going to be ending December 1. Reserves have slid from abundant to toward ample. He said that he wants to expect gradual asset purchases next to maintain these ample reserves as other Fed liabilities grow, like currency and circulation, for example. And this isn't a rate stance change, rather a way to keep control over shorter term rates. Letting reserves fall too far risks money market volatility. So he mentioned the 2019 repo spike. And then Williams wants to avoid forced interventions by stabilizing reserves now. Historically, large-scale balance sheet expansion has previously supported risk assets by improving liquidity. This time it's maintenance and not stimulus like we have seen before, but it can still reduce tail risk around funding markets. So the theme here is that's in play is that liquidity tightens, leadership begins to narrow, sentiment starts to show cracks within itself, and then policy pivots to stability. The data is saying the sentiment is fragile, breadth is poor, Bitcoin is flagging liquidity before equities, and that could be a bad sign. Fed policies cautious on rates and supportive on reserves. So that's what we got, everybody. A lot of news, and I've held you 15, 16 minutes now. I think I'll let you go for today. So hope your weekend is awesome. Hope your day was awesome. A lot of information in this video, so I'll let you digest this over the weekend, and you have a good one.